Thanks, Mark. Okay, well, Mark is joining us for our market outlook for the fourth quarter. At least for those some of you that could be in attendance. I know a lot of you guys are busy. We're having this gonna be sent out because a lot of people are concerned about what's going on in the world, what's going on in the markets, but more personally, what's going on in your investment accounts. And people don't know where to turn to. A lot of times in life, we have to add perspective to where the markets are at now and see how we can hopefully make good, educated decisions as we move forward through these turbulent times. Mark is, he won't call himself this, but I'll call him a genius. He's really good at navigating the markets, really good at looking at indicators, and really good at building these balanced, diversified portfolios that can really help amplify our returns over a long period of time. But I don't want to talk too much because Mark's going to run the show. And then I have some clients that send me some questions that we're going to kind of ask Mark at the end of his little presentation. And then if anyone has questions that's on this live, please send a message through the chat feature, the Zoom, and we'll ask those questions as well, just to make sure we make it as personal as possible. So with that, Mark, if you can take it away.
Great. Thanks, Jordan. And welcome, everybody. I'm just going to pull up a screen. Hopefully you can see that slide deck.
We can.
So I'm going to go over a little bit of a review and then fourth quarter outlook. Obviously, this has been a very challenging year. And to put it into perspective, this is the traditional balanced portfolio in the industry called the 60/40, 60% stock, 40% bond allocation. And what the orange bars there are showing is this is basically the third worst year out of the last 100 years for that traditional 60/40 portfolio. So there's a lot of good blue bars, but there's definitely some orange bars, and this one happens to be pretty sharp on the downside. So we're definitely in a rare year for markets and for portfolios. The stock market entered a bear market. Generally, the rule of thumb is, in terms of the lingo, is anything greater than a 20% decline from its high is considered a bear market. Anything between a -10 and -20% would be a market correction, and anything between kind of a 0 and a 10% would be a market pullback. But we're clearly in a bear market this year, with the market down about 25%. But that's not abnormal. Stocks do this from time to time. They also have great up years. So that's not really that abnormal. What is abnormal is the move in the bond market. So this is the last 40 years, essentially, in the aggregate bond index, representing bonds in the bond market. And most often you don't see a double-digit type decline. In fact, you don't actually have one until this year. And so bonds were down 15%. And so they didn't really offset the risk in equity markets. So typically, even going through other markets in the early 2000s or 2008 period, you had bonds kind of hold up and offset that equity risk. This year, that hasn't happened. And the reason it hasn't happened is because the Federal Reserve has raised interest rates at its fastest pace, really, in the last 40 years of rate rising campaigns. And you can see this on the left-hand side. They've just been raising rates aggressively to stem off inflation. So what the Federal Reserve does, that's the central bank of the United States, and they control monetary policy. When they're raising rates, the rates that they are raising is called the Fed funds rate, which is the overnight rate that banks lend to each other. And the idea there is if they increase interest rates, it would increase kind of the ability to lend or de-incentivize lending activity, both from the lender and the lendee. So they're raising interest rates really to slow down the economy and slow down borrowing and so forth. So they're working on slowing down demand to kind of cut off inflation and slow down inflation. Of course, they don't impact supply, but I have a few charts in here that'll address kind of the supply issues on the inflation front. Now, what's happened this year, in a really dramatic fashion, this is the history of the exchange-traded U.S. dollar. The U.S. dollar freely floats against other major currencies in the marketplace. Well, with the Federal Reserve raising interest rates so quickly, our interest rates are higher than most domestic and developed markets. And so that's made the U.S. dollar more appealing. And so all the way to the right there, you've seen this really big spike in the U.S. dollar relative to other currencies. So relative to the yen, relative to the euro, and usually a 5% move in a year against another currency is a pretty big move. This year, you're at about 20%. So it's really causing a different set of challenges in the global financial system. It's not the traditional ones that we've come to know. This is really foreign currency based. And so that's why you may see in the news that the UK has had trouble in their bond market. You may see them talk about interventions into their bond market and trying to support it. And the same with Japan and some other economies as well, looking at the depreciation of their own currencies relative to the US dollar. And what's important from a financial perspective and an investor perspective is the US dollar has a negative correlation with all the major investment asset classes. So, and that's that red bar or red boxes there. That's the US dollar against different asset classes, large cap stocks, small cap stocks, developed market stocks, the aggregate bond index, high yield, and so forth and so on, and gold and REITs. So across the board, this has been a major driver in asset markets this year that have really taken down and really had been challenging for financial markets in general. So where do we stand now? U.S. interest rates, and these are treasury rates. That's these the government issues treasuries to fund itself. Along the x-axis there, left to right, is the time to maturity. So it starts with 3 months, 1 year, 2 year, 3 year, then goes all the way out to 30 years. And on the y-axis, up and down, that's the interest rate that you get for that time to maturity. So all the way on the top there by the green arrow, that's where interest rates are today. So if you go to the 1 year, the 2 year, the 3 year, you're close to 4% interest rates on short-term money. Whereas if you drop down all the way to the lowest slanted line there, it was really low this year, below 0.5% or a year ago. So you've had a big jump up in rates. And so this is really changing kind of the risk reward standpoint for short-term fixed income investments. But what you also might pick up here is that as you go further out in time towards the 10-year and 30-year, those rates are actually lower than short-term rates. And that's called an inverted yield curve, where short-term rates are higher than long-term rates. Now, you may hear about that because the traditional signal is when you get an inverted yield curve, it's kind of a harbinger of potential slowdown in economic activity and also potential recession, which would suggest that rates would come down later at some point next year as we head into 2023, whereas we didn't have that condition a year ago where you had a normal upward sloping line. So that's a little bit in the weeds, but this is a pretty good picture of where interest rates are and where they came from. But at this point, there was a lot of fiscal and monetary stimulus. So monetary comes from the Federal Reserve. Fiscal is really approved by Congress and goes through that channel and gets kicked out by the Treasury. So those Treasury stimulus checks did not necessarily come from the Federal Reserve. So they were two separate kind of accounting books, if you will. So on the right, or on the left, excuse me, you have this big injection, the spike higher in liquidity, and this monetary impulse that the Federal Reserve kicked into the system around the COVID pandemic, really to get us through that period in time, stabilize financial markets. Now, that's normal operations in terms of what the Fed should do in a time of really unprecedented circumstances. But at this point, that has fully reversed. In other words, they've taken out all the excess kind of reserves out of the system. And so it's fully reversed at this point. And in fact, it rarely gets to a lower year over year number in terms of the decline in growth in money. On the right is the fiscal stimulus, and you can see that jumping in 2020 into 2021, but then peaking. And that has also fully reversed as well. So there's no real latent, from a monetary perspective, latent kind of inflation hangover there that's still out there. It's already cleaned up. So they've really front loaded the tightening here in 2022. On the inflation front, so that's one part of the inflation front that I just mentioned, that the tightening of those liquidity conditions. The other point is we needed to see some prices come down. One of the anomalies with the inflation picture was that used cars were priced at the same as new cars. And so that was a big anomaly, obviously. And that is something that we thought would definitely reverse. It was just a matter of time. And so on the left-hand side, you've seen used cars come back down and starting to look a little bit more normal. In the middle clip there, that's the freight index, and it just shows for global shipping rates and things like that. That has come down and is almost fully reversed as well. So that kind of clogging, that challenge getting supplies and moving supplies has really come down. And then on the right there, this shows that uh, uh, where we were a little tight on inventories and stores were tight on inventories, well, they reordered and now are fully stocked. In fact, they are over inventoried, and so we'd expect some sales as we head into the holiday season and some markdowns, which would have some cooling on inflation as well. So just a number of varied inflation gauges where we see that they've already are well past their peak and have come down, and that should show up in the numbers as we look forward as well. Another main point that the Federal Reserve was trying to cool was the housing market. And what they've done is by raising rates is had a big impact on the 30-year mortgage rate, closing in on 7%, which if you go back, you're back to the levels and really into the 90s when you see that 7% number. So that's a long period of time where we've had these low interest rates on mortgages for the most part, but really different from where we saw the 3% to end last year, start this year in those low 3% ranges. So this obviously pushes up the cost of a mortgage for new purchases or moving and so forth. So we do see numbers in the mortgage market coming down or the housing market coming down or stabilizing. So this is something they have to watch. This is a pretty big jump in that number. And obviously prices, it's just not as affordable. So affordability is much lower than it was just 9 months ago, for example. So we think this is a big deal. And will stem that housing market at this point. So a lot of the work has really been done in terms of the raising rates, tightening monetary conditions. Some of these prices are correcting and reversing from kind of the pandemic related issues, which we really think was a supply demand mismatch when you had the closing of the economy and then the abrupt reopening of the economy, and you had some pent up demand there, and then just some imbalances. This is a history of inflation spikes. And what you may take from this is that when they spike higher, they spike lower at about the same pace as they spiked higher at. And we'd expect this to turn out about the same way. And so it doesn't mean we're going back down to necessarily 2% inflation immediately, but it's going to start to work its way down to those levels. And 4% is not outside the bounds of reality, coming from kind of this 8% level, dropping to 4%, and then it may stabilize depending on the employment picture. What we do know heading into the fourth quarter is that stocks are trading well below their fair value. So markets have been on edge because you've tightened liquidity conditions, basically taking money out of the system, which is putting pressure on financial assets. And so when we look across the board, stocks generally are trading well below their fair value. Now, that's not a timing indicator per se. What it is telling us that, okay, we don't have any overvalued conditions. A lot of stocks have been oversold, meaning they just are sold because of the pressure, the macro pressure in the marketplace, not necessarily because of their underlying business conditions. So in 2000 and 2002, that big bear market after the tech bubble, well, you had some significant overvaluation, much more so than you had this period, and which was much shorter lived than that period in the late 90s. You had four very big years in the market leading up to that, and very big numbers. But also what you had at that time were companies that weren't companies, meaning those companies were going out of business, and not one or two. It was closer to 300. So that was putting a lot of pressure in the marketplace and just telling you that type of time frame that we were in. This time around, a lot of the companies, even the ones that came up and kind of got in the news because they had outsized gains, these are many of them are real companies. And one of the areas we looked at was disruptive innovation. Well, all those companies working in genomics and working at autonomous vehicles and robotics, These are real companies with real revenues and a real place. So it's very different. They're just getting this valuation discount now because of the macro environment. And then if you look at high quality stocks, they're also sold off very hard. So some of the largest companies in the world, Google, Amazon, they've all come down. Berkshire Hathaway, they've all come down pretty significantly in this correction. So it's really this moment where it's been a sell everything environment where you're selling stocks and bonds, and even gold has been hit hard. REITs, real estate investment trusts, have been hit hard. So anything in the financial markets really got squeezed with the strong dollar, rising rates, and tightening of liquidity conditions. We also know coming into this quarter, sentiment is very depressed, and we're seeing readings that are consistent with other major lows in markets. So this is called an optimism or pessimism reading. And so right now, the readings among investors are high pessimism. That's a contrary indicator. So if we see a lot of optimism, there may be some risk in the market, but when we see a lot of pessimism, that's where a lot of opportunity and the surprises to the upside. In other words, all the bad news gets out there, it filters through, investors have made their moves, and now you're subject to potential upside surprises. And you don't necessarily know what that catalyst will be. It could come in the form of something negative, whereas maybe a line of business or companies kind of break. You might hear that in the news that the Federal Reserve will raise until something breaks. But that's usually the point in time where it's kind of the end, not the beginning, where policy pivots and kind of what the overhang in the market was clears at that point. So you have a market clearing event. So it could be something that's exogenous in the sense that it's a hedge fund that just got over leveraged and has been hanging on, and then finally had to sell all its holdings, and then it gets out of the market and that selling pressure is removed, and then the markets can move higher. It could be an event where Credit Suisse, which recently got in the news, although we've done some research on this and been on calls with them, that they do have liquidity support. But it could be some banking group gets into trouble. Now, I don't think it's a global financial crisis at all. That was a much different environment. Today we do not have over-leveraged consumer or household balance sheets. They're actually in very good shape. At that time, we did, and obviously the housing market was a big part of that. Banks in general, and we put out a study a few weeks back, but just to brief on it, in 2008 or circa that time frame heading into 2008 global financial crisis, where a lot of these banks really got hit hard, their loan to deposit ratio was at about 100%. So very extreme. Today, with the major banks in the US, it's at 60%, meaning they're not lending out like they were at that time, much more conservative lending standards. And even if you look at the housing market, where the lending and the mortgage origination has been, and even the refi has been at the higher level of the credit tiers, not the lower level or the non-verifiable level where you saw a much bigger chunk of that, kind of that 2003 to 2007 period, and leading into 2008 and some of those poorer quality loans. That's not the case this time. So we don't think that's actually the issue. It's really these sovereign debt levels where you might see the UK come in and have to support their bond market because of changing interest rates and because of the rally in the US dollar relative to their currency. But here's just showing a lot of pessimism, and other points have really marked an area where you should be looking for opportunity, not getting pessimistic with the crowd at this point. One of the things we'd be looking at from a technical perspective in the market is something called the volatility index, or the VIX, if you've heard of that. It's also called the fear gauge. So if they mention that in the news, what's interesting about the fear gauge is this is a level that if it spikes higher is actually a good time to suggest that, okay, you're in this acute moment where there's heavy selling pressure, heavy fear, but that ultimately usually abates and then leads to higher stock prices as well. So a level over 30 historically has been high. The average is 16. Where that number comes from is 16 would say we expect 16% volatility in the stock market, which would be normal. 33% levels, really telling you, well, we're experiencing and expecting double the volatility in the stock market. So it's clearly elevated, and we'd expect it to come down, but it might have a uh, final climactic selling event because of some fear that pops into the market. But a spike in this number would be something we would be looking at. We would not get fearful if we saw a spike. We would actually get very constructive if we saw a spike, even though in the moment it'll feel fearful. We do a lot of these studies trying to look at cyclical analysis and finding kind of corollaries, what markets look similar to the current environment. As we stand today, 1962 looks very similar to 2022, where you had this sell off into the June lows, mid June, then you had a summer rally, then it rolled over into the fall, and then bottomed around the midterm election, and then ultimately climbed higher. And that's kind of consistent with other periods that we look at. 1962 was a midterm election year as well. And so we're carving out a very similar pattern here. And you're never sure if it'll come back as much as it did or follow it exactly. But given the fact that we're oversold, valuations are really reasonable, and a lot of pessimism is already in the market, that kind of sets the stage for, yes, you can have kind of a bounce back or some type of recovery into year end. And zooming back a little bit, it's important to put the moves in context. And these aren't predictive necessarily, but they do seem to pop up time and time again where kind of history rhymes, if you will, in real time. We've been in the worst 6 months, the May to October period of the entire presidential election cycle. And so May to October of a midterm election year historically has been the weakest performing of all the 6 month periods. That leads right into the November to April period, into the third or the pre-election year or the third year of the presidential cycle, which has been the best time period. So I'd keep that in mind. You're not certain if it's going to kick her off around midterms, but it certainly has been following this path. And it's interesting. We've looked back at this and you think, well, why is it the presidential election? Isn't it based on the 4 year economic cycle? If you go back 120 years, say to have a little bit more to do with just the economic cycle and we're a little more agrarian as we're emerging into the industrial phase, but that still played a pretty big role and influence on kind of the ebb and flow of markets and seasonality of markets. Now it's really transitioned towards in the last 50 to 70 years where there's pretty good data that suggests that actually it happens to be the presidential cycle, just the timing of these moves. And a lot of times after the midterm election year and heading into the pre-election year, the Federal Reserve wants to get out of the way so it's not the reason, raising rates and possibly causing a real slowdown in the economy, because that can cause obviously concern for any of the incumbents. But that would be a battleground. So they kind of want to remove themselves. At least that's historically been the precedent. And remove themselves from the equation and try to let the parties duke it out, if you will. So that kind of is lining up at this point. They front loaded a lot of these interest rates where we think, geez, you can give it a little bit of time here to see how these interest rates work through the economy. The markets get hit first before it really shows up in the economic data. So that is just putting some things into perspective. But I think the low values are something to keep in mind, because you can always know the price of something very easily in the internet age, but you don't necessarily know the value. And that's why we relied on that chart I showed earlier that was really looking at fundamental fair value of companies in normal times. So with that, that's kind of my prepared. And Jordan, I don't know if you want to jump in with collecting any comments or thoughts or questions. I'd be happy to discuss. Mm. Mhm.
Hey, sorry about that, Mark. You had control to unmute me, so I apologize. I was silent there for a second. You had me in awe. Um,
Yeah.
but a few clients have already asked me a few questions, and you got the technical analysis. We have, the data that you're obviously researching and you're looking at, and we're looking at historical trends and really the valuations. But a lot of people, even though they might say, "Hey, this could be a good opportunity," right? We're not out of the woods yet. People don't want to put all their money at risk right now. But this economy and this market also maybe can give us some opportunities. Is there some things that we can look at from an optimistic point of view that we can maybe have some risk, but maybe minimize the risk and the opportunities available right now, that you kind of speak to the audience on?
Sure. One of the areas we found value, and I mentioned the 60/40 portfolio prior to that. Well, in today's environment, I think there's a lot other options that you can actually add to your portfolio to take advantage of an elevated volatility type of marketplace, and extract what they call premium from the market. And we use something called structured notes, which are a financial instrument issued by many of the major large banks, actually the capital markets desks of those banks. And so that's right out of New York, basically. And then they market to some financial companies. We've actually built a pretty nice team to work with the capital markets desks. And what the structured note gives us is a defined time to maturity. So our standard note is 1 year. It gives you a coupon, and recently, the coupons have been in the 10 to this month they're 13% and above, and that's paid over on a monthly basis. That's an annual yield, but it's paid out. So you're collecting that premium, and then your principal is protected a little bit different than a bond, but your principal is protected up to a 30% decline in any one single underlying index. And we use this S&P, the Russell 2000, and the NASDAQ 100. I know I'm going through this quick, and it's just to give you a highlight of what they are. In other words, you get some principal protection that's unique. It's not necessarily interest rate risk, but you get above average coupon, and you get a reasonable term backed by one of the major large banks. So it's really unique in the sense that it wasn't suffering like the bond market would suffer if you just have interest rates rising and declining. And that above average coupon, I think we found, has been a very nice complement to traditional stocks and bonds in a portfolio.
And I agree. I know a lot of my clients that I'm working with now, we've laddered those into the plan because they're giving you great returns. They still have risk, but we're trying to minimize the risk with interest rates and with a 30% buffer. Maybe just to elaborate on something that I don't think I've done a whole lot for my clients, but this last couple of months, you guys have found an opportunity in structure notes for maybe those of our clients or people on this call or listening to this call, and they're thinking, I don't want to take any, kind of market risk directly in the market. I want my principal kind of protected. I think there's a note out there that can actually protect some of the principal as well. Can you elaborate more on that?
Sure. So we go to these capital markets desks and we negotiate custom notes based on the terms we provide. And so that note prior to that I was mentioning was really to generate an above average coupon and get that income flow coming into the portfolio. The other note that we've liked is something called a principal protected note. And what this gives you, for example, is a 2 year time period. Your principal is protected, and you track the S&P 500 up to a cap, a maximum return. And right now that maximum return is 18%. So that's a pretty good return over 2 years, especially given the level of principal protection.
Yeah, and those I think fit some people, but doesn't fit every portfolio. Obviously, if the market doesn't recover fastly, which we're not saying is going to happen next week or next month, you might make more in some other investment vehicles. But for some people, they want to kind of maybe jump in the market, but maybe instead of a structured note for income or having an 18% cap on that note, maybe they want more upside potential, but they want a little bit of a safety net in the equities. I think you also have a strategy that we're actually starting to implement with clients to kind of give them a little downside protection, but still help them participate in the future market growth. Can you explain that strategy a little bit to our clients?
Sure. These are relatively new investment vehicles. They've been around for a few years. but they're really new to implementing them in portfolios. They're called buffered ETFs. What they are a strategy that gives you upside participation over a 1 year time period in the S&P 500 up to a certain level of cap, and then downside protection. And they come in three versions generally. The first one would buffer the first 9% of the decline. So you'd essentially have to lose 10%, or the market would lose 10% before you'd be down 1%. And then another one has that buffer at 15%. So it would absorb the first 15% of the downside. And another one does a -5 to a -35% of the downside, meaning you just absorb the first 5%, but then you'd be really protected for the next 30%. And then you get differing levels of upside. And for the more conservative one, you get upside in that right now, probably in that 10% range. And then you go up by a few percent in the next ones in 12 to 14. And then recently in that 14 to 16% range for the 9% buffer. But these are really good upside participations, given, again, that level of principal protection. But they're we think they're very innovative. We've tracked them for the last several years. And what we do when we're looking at an investment vehicle and say, can this deliver on its value proposition in good times, but also in times of stress? And they did just that during 2020 and also year to date. So they've really been stress tested in real time with some really challenging market environments.
Thank you for that, Mark. And I don't go too detailed on all the investment options, but clients sometimes wonder. I have a question from a client. They wanted me to ask you, like, should I just put everything in cash? Should I be in cash? I mean, the markets are down, I have my perspective, but instead of me talking, I want to hear, Mark, is all your money in cash? I mean, should everyone's money be in cash right now, with everything going on? Because not to be too negative, but there's a lot going on in the world. Like, what do you think about having your money in cash?
Yeah, it can feel good at a time to get out or go to cash or something. And now it pays a little bit of interest and it may seem appealing, but just going back to valuations are very low. So you'd be selling really undervalued assets, knowing that, well, geez, once these issues pass, and remember, issues from year to year change. It was just COVID issues that we're dealing with 2 years ago. Now it's an inflation issue that we're dealing with momentarily, and it'll be different. But history suggests that markets come back and then build on those returns over time. So I think you have a lot of opportunity in the market today where I would say, yes, it may feel good to minimize kind of that volatility aspect of it, but you also benefit on the upside of that volatility. And the real reason you're investing over time is to maintain and grow your purchasing power over time, or preserve that purchasing power over time, meaning keep up with inflation. Now, in the short term, it may feel like, oh, there's inflation, but markets came down. But markets usually find a way to overcome. Why? Because earnings grow, and earnings can benefit over time from inflation, as well as pricing power works its way through.
And Mark, you're the numbers guy, but I just want to ask you a question. Historically speaking, correct me if I'm wrong, but the markets have recovered 100% of the time.
Correct.
Okay. Just want to make sure. Okay, so I'm a history guy. We don't know if it's next month. We know if it's next week. And just for those that are watching, Mark handles our risk portfolio, securities, market fluctuation portfolios. A lot of you that are on this call and that know that what we do here, we do a lot of investments that have no market risk. So you should sleep good at night knowing that if you have an annuity or something like that, it hasn't actually lost money in this last 9 months. Okay, but we know that we need a balanced and comprehensive portfolio. Mark leads our investment team. If you have any specific questions, I love to answer that personally to you. That's all the questions I had so far for today. But Mark, thank you for your time today. We'll look forward to seeing you at some of our educational events in the next few weeks, and I appreciate your time.
Sounds good. Thanks, Jordan.
Take care now. And Mark, you'll have to close the meeting because I made you host now.